What's up, Autonio traders? Today we are going to be covering the second half of these indicators, starting with rate of change. First up, we have the rate of change, also known as the ROC. And this is a technical indicator of momentum that measures the percentage change in price between the current price and the price end periods in the past. The ROC simply measures the strength of price momentum by the rate of change. So let's look at Bitcoin's chart, and you can see that the ROC fluctuates above and below this zero line here. When we see this come above the zero line, that's an indication of upward buying pressure or momentum, while the negative values down below zero indicate high selling pressure and negative conditions in the market. And next up we have the Relative Strength Index, or the RSI. And in technical terms, the RSI is a momentum indicator that compares the magnitude of recent gains and losses over a specified time period to measure the speed and change of price movements of a token. It's primarily used to attempt to identify overbought and oversold conditions. So this is really easy to do with the RSI. It gives you this purple safe zone here, and anything below the safe zone is going to be oversold, and anything above the safe zone is going to be overbought. So when we see the price come way up above 70 and start to turn down, that's a great sell signal. And when you see it come way below 30 and start to turn up, that's a great buy signal. And next up we have the simple moving average, also known as the SMA. And there are three other moving averages that we're going to be looking at, so I'm going to talk about them all at once because they can pretty much be interpreted in the same way. So a simple moving average is arguably the most popular technical analysis tool used by traders. It's often used to define trend direction, but can also be used to generate potential buy and sell signals. Now this is very simple to calculate, just as the name would suggest. It's calculated by taking the average of prices from a previous time period. So if you took the 5-day SMA, you would take the sum of the closing prices for the last 5 days and divide that by 5. Now the EMA, or the exponential moving averages, weighs current prices more heavily than the past prices. So this gives the exponential moving average the advantage of being quicker to respond to price fluctuations, so it might detect a trend a little bit quicker, but it also leaves it vulnerable to whipsaws, which are where the price moves abruptly in the opposite direction than expected. The weighted moving average also places more importance on the recent price moves because they're a lot more relevant than the distant past price movements. So it also has the advantage of being able to predict a trend a little bit faster than the SMA, but again, it has the disadvantage of being super vulnerable to whipsaws. The main difference between the EMA and the WMA are the way that they're calculated. So they're both weighted toward the most recent prices, but the rate of decrease between one price and its preceding price are not the same. With the weighted moving average, the rate of decrease between one price and its preceding price is linear. So every single day it'll decrease by the same number as we go further into the past. So if it decreases by a weight of 1/15 every single day, we'll see it go down the same exact amount every single day. But with the EMA, it goes down exponentially. So for example, if today's weight was 100, yesterday's weight might be 10, and the day before that might be 1, and the day before that, 0.1. And so that actually decreases much, much quicker than the weighted moving average. And so because of that, the exponential moving average is more heavily weighted on current prices than the WMA, which is a little more spread out. And the last moving average we have is the smooth moving average, which is calculated the same way, it's just over a longer period of time. So the moving average represents a greater trend. Now all of the moving average indicators can be interpreted in a similar way. So when you see this price action come above the moving average line and start to form higher lows, that's a confirmation of an upward trend. And when we see it fall down below the moving average line and start to find lower lows and lower highs, that is a downward trend. And next up we have the Stochastic Oscillator, also abbreviated as KD. And the Stochastic Oscillator compares the closing price of a token to the range of its prices over a certain time period. So it's pretty easy to use, and it's a pretty accurate indicator for buys and sells. You have two lines here. So the faster line, meaning the one that's in front, is the K line, and the one that's trailing a little bit behind is the D line. The K line indicates the number of time periods, and the D line is the moving average of the K line. When the K line drops below 20 down here and outside of our safe zone and starts to turn upward, that's a great buy signal. And then when you see the K line come outside of our safe zone up top above 80 and start to turn downward, that's a great sell signal. The buy and sell signals are usually accompanied by a crossover. So you can see when Bitcoin bottomed out over here, the K line crossed under the D line, and when it topped out up here, the K line crossed over the D line. And next up we have the triple exponentially smoothed average, also known as the TRIX. And this shows the percentage change in a triple exponentially smooth moving average. So similar to the other moving average, this is just designed to filter out all of that excess noise and all these extra price movements that don't actually correlate to the underlying trend of the market. So when we see the TRIX hanging out above zero, we're in bullish market conditions, and when we see it slip down and fall below zero for extended periods of time, we're in bearish conditions. Next up, we have the volume weighted average price, or the VWAP. Now, the VWAP is exactly what it sounds like. It is the average price weighted by volume. So the VWAP equals the dollar price of all trading periods divided by the total trading volume for that current day. So let's take a look at Bitcoin's VWAP. So it's actually pretty simple to read. When the prices are falling below the VWAP line, that's when prices are generally going to be dropping, and when prices are above the VWAP line, that's generally when prices are going to be rising. Now, the VWAP is great because it incorporates volume. So it's not just a moving average that factors in price, but it actually gives more weight to areas where we have more traders. The VWAP can also be used to identify trends. So when you see the VWAP sloping downward, that indicates a downward trend forming. When you see VWAP horizontally, we can assume that the market is going to move sideways. And when you see VWAP start to move upward, we can expect the market to move up as well. And last up, we have the Williams percent range, also known as the W%R. And this is a momentum-based indicator that identifies overbought and oversold conditions similar to an oscillator. And it's used to establish entry and exit points in the market. It compares the close of a stock to the high and low range over a period of time, which is typically 2 weeks. So let's take a look at the Williams percent range for Bitcoin. And you can see it looks a lot like our stochastic oscillator, and it has this safe zone between -20 and -80. So when we see the indicator come up and almost scrape zero, that is an indication that it's overbought, and that's a great time to sell. And when we see it come down to almost -100, that means it's oversold, and that's a great time to buy. And that is it for the indicators. If you guys have any questions for us, please don't hesitate to join our Telegram channel at t.me/Autonio, and happy trading, guys.